Welcome back to part 2 of 2018 and 2019 tax update and tax tips webinar. In this section, we will talk about the new tax law effects on businesses. We will talk about all the changes that's going to affect businesses that will eventually flows through to your personal tax return. So let's get started with the first new deduction that is brand new for year 2018. It is a 20% deduction qualified business domestic business income. So in essence, if you have $100,000 income from a business, you would be entitled to a 20% of that amount, meaning $20,000 deduction on your personal tax return against your taxable income. So it will reduce your taxable income and therefore reduce your tax liability for any business related income. Of course, it has some limitations that we will talk about shortly. It's applicable to sole proprietorships, partnerships, S corporations, and it does not include income from C corporations. And of course, as I said, it reduces your taxable income, have no effect on self-employment income. It has some limitations. The first one is it is only up to 20% of the income from the business. So that's pretty straightforward. The second one is subject to businesses that are above the threshold. So for joint tax returns or joint filers, married filing jointly, the threshold is $315,000. For everybody else, it's $157,000. So if your income is below these levels, you don't need to worry about any of these limitations. And the second limitation and the third limitation, you don't need to worry about that. So if your income is below that, but if your income is above that, then, and if you are married filing jointly and you are between 315 and 415, and for individuals and everybody else, if you are in this tax bracket, then you start losing a portion of that credit based on some limitations on your W-2 wages from the business, and some other deductions. So I'm not going to go into details, the mechanics of it. You guys don't need to know about that. It's just that this credit is available out there and it can be utilized if your income is below these thresholds, and you start reducing it if your income is below is in between these thresholds, and you totally lose this credit if you are a service oriented business and your income is above this. 415,000 for joint people, and for everybody else it's 217. So if it's above that, you will lose the credit. For everybody else, you will still get it, but it will be reduced above these levels. So that's the credit. It is, as I said earlier, available to self-employed, Schedule C's, and partnership. What it is not available is all this. Service-oriented businesses are health, law, accounting, and so forth. So there is a list there. Some of the businesses that are excluded from the services are real estate brokers and so forth. So we have I have listed all these here as a reference. This flowchart summarizes what we talked about, the new tax credit. So if you are a service-oriented business and income for married filing jointly is above 415, there is no credit. And if you are between these thresholds, you will get it, subject to limitations. And if you are not a service-oriented business, then you do get it, but subject to W-2 wages and the threshold for other deductions. Here we will talk about its effects of on entity selection. Before, the choice between LLC and S Corp was relatively straightforward. On LLC, you pay Social Security on your whole income, whereas on S Corp, you pay Social Security on only wages you take out from the business. So in this example, if you have 100,000 in wages, you will pay Social Security of 15,000 for LLC, whereas on S Corp, if you take a salary of 80,000, you only pay taxes, or you only pay Social Security on that 80,000. So in essence, there is a 3,000 savings for S Corp. But now we have to consider the new business deduction as well. For LLC, that deduction will be 20% of this 100,000, which will be a deduction of $20,000, whereas on S Corp, you cannot consider or include the wages, so you have to subtract the wages from the income and get the credit only net of the wages. So it's going to be 80,000 minus 100,000, that gives you 20,000 times 20%, which is $4,000. So the benefit for the new tax credit would be a little bit higher for LLCs, but you have to add these two benefits, and at 12%, it's still, in this particular example, more beneficial to be an S Corp. But we move to the second slide at 22%. If you are in a little bit higher tax bracket, then the benefit shifts to LLC. So the whole purpose of these two slides is to just let you know that going forward, you have to consider this new tax deduction in entity selections. If you are our client, we can help you with the entity selection while considering this new deductions. If not, then you can research this on your own. There is a new limitation on losses from businesses if that loss exceeds $500,000 if you for couples, or $250,000 for individuals. Any loss above that from businesses would be carried forward. So a big change here, applicable for businesses with bigger losses. Unfortunately, it will be capped going forward above these threshold amounts. Another limitation on business interest, it is also capped at 30% of income. Net operating losses for individuals, huge changes here. Going forward, we can only carry it back. So on your personal return, say if you have a net operating loss, you can no longer elect it to carry it back, but you can only send it to the future years. And even if you send it to future years or carry it forward, it is limited to 80% of taxable income in that year. For C corporation, as we can see previously, we had a lot of different rates at different thresholds. Now we just have to worry about one rate, 21% C corp rate. And the same rate would apply to personal service corporations. Even at 21% for most small businesses, it's still beneficial to be an S Corp or a partnership, because C corporations are taxed twice. As an entity, you are taxed, and then when you are taking out any profits from the business, you are taxed again. So it's a double taxation on the C corporation. Plus, we have to worry about the state taxes as well for C corporations. So S Corps, partnerships, for most part, are more beneficial for small businesses. On depreciation front, there are also a lot of changes. If we are doing your tax return, we will take the optimal amount of depreciation, which doesn't mean to take the most aggressive kind of depreciation, because sometimes you don't need a lot of deductions. You would rather stagger those expenses over the years so that you can benefit over a number of years. But starting from 2018, now we can potentially take 100% of bonus depreciation, so which is extremely generous, and you can pretty much deduct dollar for dollar most of the fixed assets you buy. As we can see here, this will expire at the end of 2022 and the 100%, and then it decreases, and after 27 we lose the bonus depreciation. For luxury autos, there is a further limitation. You cannot deduct it dollar for dollar, but for the first year with the bonus depreciation you can deduct up to $18,000, and in subsequent years these are the limitations. It's still good, but it's not dollar for dollar, unless if the weight of the car is, or SUV or van or pickup, is more than 6,000 pounds, then you can potentially take 100% bonus depreciation. So if you buy an SUV for $100,000, you can deduct that dollar for dollar if it's for 100% business use. So as we can see here, the depreciation is only available when you buy the car, and the bonus 100% depreciation would be available on the SUV if you buy that. So the recommendation here is, if you have to, then instead of leasing an SUV, you will buy that. And all the other auto luxury, since there are limitation on it, you can potentially lease those cars. Section 179 expenses. You can expense up to $1 million. Now that we can take 100% bonus depreciation, it significantly lessen the importance of section 179, because why would you want to take section 179 when you can take 100% bonus depreciation? But there are certain items that you can take bonus depreciation, or that you can take section 179, namely on improvements, commercial real estate and so forth, that you cannot take the bonus depreciation. And of course the section 179 is indexed for future years as well. Under the accounting methods, now you can still be on cash basis of accounting if your gross revenue from the business is less than 25 million. Previously it was 5 million. So now a lot more businesses can potentially be on cash basis. And in previous years, if you have already transitioned into accrual basis because of the threshold limitation, and we have done that for some of our clients, now you can go back and elect to be on cash basis if your income is below the $25 million threshold. Moving on to like-kind exchanges, now it is only limited to real property. Before, if you traded in your car, that could potentially be a like-kind exchange. Now it is limited to a real estate only. And then there was this deduction of production activity deduction. It was mostly available for manufacturing businesses that were manufacturing in United States, and we have taken that for a bunch of our clients as well previously. Going forward, you would not be allowed this deduction. It's been repealed. On the entertainment front, anything that constitute entertainment, amusement or recreation is not deductible starting from 2018. So we have some examples here: membership dues, golf course fees and so forth. Anything that relates to entertainment is no longer deductible. For meals, qualified business meals are still deductible, but keep in mind that they will also go away after 2025. So after 2025, both meals and entertainment deduction would not be allowed. And keep in mind that the meals expense has to be ordinary and necessary, and it cannot be too lavish. For employee achievement awards, if you give your employee cash or cash equivalent or gift cards, it is not deductible unless you include that in their W-2s. Similarly, for exempt entities, providing fringe benefits to their employees could be considered unrelated business income. For 2018, we have a brand new tax credit called New Family and Medical Leave Credit. It is available when you pay your employees for family and medical leave, and it is limited to 12.5% of their wages. And there is a wages limitation of $72,000 as well. The new tax law comes with limitation on excessive employee compensation, which is limited to $1 million. But as we know, CEOs of big corporation makes a lot more than that, and they do that through stock options and other methods, and there are still no limitations on that. It's just a salary portion of their compensation. AMT for corporations is totally repealed, so going forward we don't need to worry about AMT for corporations. Foreign income, this slide is mostly for big corporations. As we know, these corporations only pay US taxes when they bring in those profits to United States, so a lot of companies were not bringing in those profits. So to encourage them to bring that money in, they will be taxed instead of 35%. They can pay between 8 to 15% in taxes, and to encourage them to bring that money to United States. You have to disclose foreign assets if its value is more than $50,000 for individuals or $100,000 for married filing jointly on Form 8938. For foreign bank accounts, if at any time during the year its value is more than $10,000 and you are a signer on it, then you have to disclose that on FBAR. It's an online place. You can go there, enter some information about the account, and you can fulfill that filing requirement. Failure to filing this form can result in significant penalties. As we can see, willful failure to report could result in penalty as much as $100,000, or non-willful reporting is there is a penalty of $10,000. So significant penalties. So make sure either you're not a signer on a foreign bank account, or if you are, then you do file those forms. Foreign gifts, if you are a recipient of a foreign gift for more than $100,000, then you would be required to attach Form 3520 to your personal tax return. The rest of the slides in this webinar are for reference only. A lot of our clients ask us their chances of being audited. It's less than 1%. 1 in 104 returns are audited, and face-to-face audit is even less. It's 1 in 417 returns. And then as the income goes up, your chances also goes up for the audit. As we can see, for all the returns, this is based on the most recent data from the IRS for year 17. For all the returns, the probability of being audited is 0.7%. For individuals, it's 0.6%. If you have Schedule C, sole proprietorship between 100 to 200,000, the chances are 2.1%. So it goes up. As we can see, for S corporations partnership, it's relatively low, 0.3%, 0.4% as compared to sole proprietorship. So that's something to consider. And if you do get audited, majority of the audits are correspondence audits. A very small amount are the actual field audits or face-to-face audits. So what are some red flags for being audited? Of course, as we said, making too much money, that itself is a red flag or increases your chances for being audited. Failure to report 1099s and W-2s and all the other forms. Naturally, IRS gets a copy of this, so if you don't report it, they will send you a notice that you eliminated portion from your income. Taking large charitable deductions, that's a red flag. Taking or claiming home office deduction, claiming rental losses, meals and entertainment, taking 100% business use of vehicle, any commute between office and home is not an expense, so it's very difficult to justify 100% use of business vehicle. And hobby losses on Schedule C's, that could trigger. Running cash business itself, failure to report foreign bank accounts, we talked about that. Engaging in currency transactions, as we know, any cash transactions over $10,000 get reported by the banks and other institutions to the IRS. So if they see a lot of that, that could trigger an audit as well. And finally, taking higher than average deductions. For example, if your income is $100,000 on average, at that level, people are taking charity of $3,300 and medical expenses of $8,000 and taxes for this. If you claim $30,000 at that income, that itself all of a sudden is extremely higher than the average and can potentially claim an audit. It doesn't mean that you cannot take that deduction as long as you have all the documentation and supporting work papers with it, then you are okay, but it's just that it increases your chances for being audited. And finally, the tax itself, you are in the top tax or top rate of 1% if your income is more than $480,000. In that tax bracket, they pay 37% of all the taxes. The top 5% pay 58% of all the taxes, and you are in the top 5% if you are making more than $197,000. The bottom 50% pay only 3% of total federal taxes. If you owe money to IRS, naturally you will accrue interest and penalties. There is a failure to pay penalty of 0.5% per month that you accrue, and a 5% failure to file penalty if you are beyond the filing date. So it makes sense, if you have the resources available, to pay the tax liability as soon as possible. And the best way to do that is to pay it on the IRS website at this URL. If you are thinking of paying it in next 120 days, then you can fill out the online application at this URL address. If you're going to be paying it after 120 days and the tax liability is more than $50,000, then you would be required to complete this form. Or if it's less than $50,000, then you can fill the online installment payment plan application at this URL address. And if you do qualify for offer in compromise, then you would be required to fill their paperwork. And in order to see if you qualify, you can go at this URL address to see if you qualify for offer in compromise. And one of the best way to adjust your payments to the IRS or increase your payments to the IRS is through adjusting your withholdings on your W-2s or to make estimated tax payments so that you don't owe in future years. The last segment of this webinar, we will talk about some forecasts and statistics and some maps that could be used as a reference and in your day-to-day business as well. Here we can see its forecast for 2019. We expect the GDP for United States to grow at 2.7%, and similarly you can see all the forecasts for energy and all the other forecasts as well for inflations and so forth. And here we have statistics on housing and price changes as well. This slides show the average or estimated tax impact of the new tax law. So for example, in this scenario, if your income was at $325,000 under marriage status, you would expect that your tax liability would go down by $9,600. And similarly, you can see at different income levels and at different marital statuses. These slides are very interesting. The remaining slides, you can use it in your business as well. The Tax Freedom Day, this is the day till that day of the year you work to pay your taxes. So in state of Florida, it's till April 20th. You work till that date towards your taxes. This day was not always that high. Earlier it was much lower, and now it's almost till the end of April. The taxes that we pay are more than what we pay for housing, clothing, and food combined, so it makes sense to allocate your resources in tax planning so that you can lower this part of your one of the biggest expenditures. Here we are showing that state and local tax collected per person. Florida, as we can see, state and local taxes on average, we pay $3,000 as compared to $8,000 in New York. Here it's state income tax for different states. The ones in gray, there is no income tax. In Florida, taxes and so forth, there are no income tax. So there is no income tax, and the other ones you guys can see there. Here, how the state taxes conform with the federal ones. Pennsylvania and these other ones do not, and the others do, and these gray ones, naturally there is no state income tax. Moving on to state sales tax. This is on average how much each state pays, an individual pays in these states. This is combined state and local taxes. In state of Florida, the state sales tax is 6.8% as compared to, you can see it in the other states. In New York, it's 8.49% and so forth. Here we have states that charge inheritance or estate tax as well. So these will be the states where not to die if your income is going to be above the thresholds. So all these slides are not only for information, but you can use it in decision making as well. Here it's a corporate business tax ratings, and this is the corporate tax rate itself. Some of these gray stacks have no corporate tax. In state of Florida, we have corporate tax rate of 5.5%. Other states don't have it. This is capital stock tax. Some of these states charge that. Here, property taxes. This is the averages for different states. Here we have excise tax and amounts for each state. And this shows where people are moving to on average. Here, the excise tax on cigarettes and financial aid states that rely most on financial aids, and we can see that here. And finally, this shows the relative value of $100. So $100 in Florida is worth $86 in New York. That concludes our second part of our webinar. If you have any questions, feel free to contact us and we will be more than happy to answer your questions and concerns. Our telephone number is listed here, and here is our email address and our addresses as well. Thank you very much.